Let's get some insights in the news shaping the markets. For that, we welcome in Rob Williams is with us, Managing Partner, Chief Investment Strategist, Sage Advisory. Good morning to you. As we've gotten in some of our information, we're waiting on CPI and PPI and things this week, but we've heard from the Fed. We've gotten some jobs reports. We've seen some key on inflation. How are you feeling about this second half of the year?
Yeah, I mean, look, for us, I think it's the two things you need to think about is duration on the fixed side and diversification on the equity side. Two things that did not help you in the first half, much better setup to help you in the second half. Like you said, we've got jobs data. Jobs appear weaker than even the surface level kind of headline numbers. If you look a little bit under government-driven job, some of the more forward-looking parts of the job market are definitely ticking up. Jobless claims, small business hires. So I think, I think the economy may be weakening a little quicker pace than people think. Give some latitude for the Fed to cut, but at some point, bad news can turn into bad news for the equity markets.
Yeah, and you don't think just cut. You're thinking 1 to 2 cuts this year and a few more next year, right?
Yeah, I mean, that's the plan. That's what the Fed has laid out. That's what the market is pricing. I think for a fixed income investor, you step back and say, at least the market is pricing more in the realm of reality, right? 9 months ago, we were pricing 7 cuts this year. So that wasn't reality. Then we almost shifted to hikes. That wasn't reality. I think 1 to 2, towards the end of the year, they certainly have the latitude with inflation and the labor market starting to weaken. And then, if you look at 4 next year, that's 150 basis points. That's a terminal rate, year end 2025 of 4%. So I think it's important to remember the gravitational pull here for fixed income investors is rates down, right? There's going to be some volatility for sure. The elections, the incoming data is going to bump yields around. But for positioning and having some duration and moving out of cash, it's a good thing to think about. The gravitational pull is probably towards 3% or 4% or below over the medium term.
Yeah, you're leaning towards fixed income, right? Really looking for not even chasing yields, but looking for quality.
Yeah, because the fixed income market, there's no reason to reach for yield right now. You're getting good yield in safe fixed income, but spreads are very tight. Valuations are tight, so you don't have to reach for yield. Late in a cycle with valuations and credit very tight, that's a time to be conservative in the fixed income. Just maybe have more fixed income. I'm not saying the equity market can do poorly. I think two things need to happen. The rally needs to broaden out a little bit, and then you're probably going to have to weather some bumps in the equity market. So from a risk return, when you look out over a couple quarters, fixed income at 5+% yield looks pretty good as long as you stay safe and you don't have to go out into the higher volatility, higher yielding markets aggressively right now.
Right, understood. I mean, when we went through the jobs report and we saw government, healthcare, social assistance, construction, those were the areas that saw some strength. Do you expect any changes to happen? Because if the market starts to pull back a little bit, it sounds like you're a little bit tepid. Do you foresee changes happening?
Yeah, well, you're exactly right. Look, the 200,000+ jobs created in June, 150 were, you could call them government directly in healthcare, which is some of that's government related. So a big part of this has been driven by fiscal spending, which is going to be difficult to continue at this pace. So if that slows down, that's a growth, weakener. And I think what we're starting to see big picture is hints that the consumer that had a lot of excess savings, if maybe that's finally starting to tap out, and maybe we are on a weakening trend. And equities, fine, they're going to like when the Fed starts cutting, but the difference for equities is we've had big gains already in the first half. I know it's concentrated and valuations are high. So at some point, the markets may have to evaluate, is this Goldilocks? Because, the Fed could look actually behind the curve if the economy starts weakening more aggressively and they're being very slow on the cuts. So that could be difficult for the equity market in the back half. So even if it has some upside, it's got to be broader and it's going to come with more bumps for sure.
Yeah, I know healthcare and energy are sectors you were looking at for the longer term, I guess, or the back half. I mean, when we think about commodities, tell me a little bit more about that story and what might be of interest to you, Rob.
Yeah, the fact that commodities have had bouts of outperformance and consumer staples and some of these defensive sectors, they're not, they're still mega cap growth is still sort of hard to beat at the moment, but you get in these bouts of these traditional late cycle outperforming markets when I'm at the end of an economic cycle. That's starting to show up more. So it's saying, hey, the market had this view that it's Goldilocks, we're in the middle of an expansion forever. Now they're starting to maybe say, hey, we may be in the later part of the cycle. So that's what gets us to like healthcare and energy, because energy and some of those commodity markets have been cheap, and healthcare and staples are traditional defensive. So I think you start adding a little bit more of that into the portfolio just to get diversification, not bailing on some of the parts, the mega cap growth complex, but at least diversifying some of that out for the back half for sure.
Look, maybe I'll leave this on a good note. 55.83 was our high on the S&P 500 today, so it's exciting once again to see record highs, intraday highs at least. Do you foresee that we'll be having some volatility or seeing some new highs?
Sure. When you're at the high, it's easy to make more new highs, right? But I do think, look, summer seasonals are more challenging. Some of the technicals are starting to get, toppy or at least show complacency. We know, look at some of the political upheaval in France has kind of derailed the path of kind of relative European equity returns versus U.S. So it doesn't take much on the geopolitical front and the political front to interrupt this. But we think the big thing is just the notion of a harder landing, not a hard landing, but just the notion that that recession probability is not zero. The equity is going to have to price that in. And they're not pricing that in right now. They're pricing in pure Goldilocks. So even the notion of a recession can give the equity market some problems.
Okay, Rob Williams, great to see you at Sage Advisory. Thank you for all of that. Appreciate it.